Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us in the MarketSite studio, we have Matt Kassel, Chief Operating Officer of Edgewater Markets, to discuss why what the Fed discusses impacts the global economy, particularly the currency markets. Matt, it's great to see you again. Welcome back to Trade Talks.
Thank you for having me back.
You got it. Remind us of the role that Edgewater plays in the industry.
Sure. Edgewater is a technology firm that provides three-pronged solution for our clients. We provide a custom-made end-to-end technology solution for our customers to be able to access global markets, and it enhances their franchise. We provide customized liquidity solutions for each one of our clients, which allows their ecosystem and sandbox, so to speak, to be a global ecosystem. And we provide credit intermediation for them as well, so that our clients are able to interact with clients all over the world, whether they know them or whether they don't know them. Our credit intermediation services allow them to interact with one another.
For those who don't follow FX closely, explain to us why what the Fed discusses is so important to the global economy, particularly the currency markets.
So the Fed really has three mandates. Its first mandate is price stability. Its second mandate is to promote full employment, and its kind of pseudo third formality is to be the lender of last resort. What we're talking about next week is really going to be what the Fed does with interest rates and what their kind of forecast is going forward. And interest rates are very important to the global economy and also to the currency market, because the interest rate is basically the cost of money. And when someone raises the cost of money, it kind of slows down investment, it slows down hiring, it slows down growth within not only the financial markets, but on Main Street as well. And so next week, when the Fed presumably will be hiking by 25 basis points, they'll be raising the cost of money higher as well.
Right, and for those catching the replay, July 26th, of course, is what we're referencing, not
Yes.
a different date. When do you anticipate this cycle to end, and what could that impact of that cycle be?
Well, we have an interest rate decision next week, and then I don't believe there's a Fed meeting in August, and then there's another one in September. But between this next Fed meeting next week and the one in September is going to be the Jackson Hole Symposium, and it's critical to understand how important that is in framing the next 6 to 9 months for Fed policy. Every year, the Fed kind of outlines what its pattern is going to be for the next 9 to 12 months, and they've never deviated from that. So in between the meetings, there's going to be that Fed symposium, and the market will be taking a good look at that. For me, the Fed has been on the same path it's been on since March of 2022. It's a more restrictive policy. They'll likely be hiking next week, and the market keeps trying to forecast when the Fed is going to loosen their policy, and I just don't see any time in 2023 or possibly even Q1 of 2024 where anything like that is on the table.
Yeah, I mean, they haven't given any indication that they're going to divert from the policy that they have in place now. We knew, within 9 months, it went up 500 basis points. Do they really want to reverse track and make the mistakes that we saw in the late 70s and 80s? I think they've been very clear in telegraphing that. Perhaps a pause, but a cut, I don't see it either, to be honest.
I agree with you. I think it's also important to know that when you listen to Chairman Powell in 2021 or even 2022, it was not just about interest rates, but it was also about the liquidity that they were injecting into the market. These are assets that the Fed buys and adds to its balance sheet, and it in turn is additive to a looser monetary policy. Now as the Fed's been hiking interest rates, they've also been removing that liquidity from the Fed balance sheet. So when you remove money from the market and you make the cost of money more expensive, it should have a play-on effect and help get our inflation rate down to the 2% target, which will take, I believe, several years to achieve.
Yeah, but once it does start to come down, in theory, cost of capital should be cheaper, which would be good for the markets overall.
Of course, it just may take, it took 2 or 3 years for us to build up to this point. It's going to take 2 or 3 years for us to unwind that a bit.
All right, appreciate the insight as always, Matt. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.